Hello and welcome to this week's episode of Nucleus Investment Insights. Today's episode is called What's in Store for 2023. I'm yet to meet anyone that has a crystal ball, but there are plenty of commentators out there that speak with such certainty that you think that they do have one. We here at Nucleus Wealth are under no illusions that the future is uncertain. However, we do believe in a cause and effect world, and we like to work on probabilities and make the most informed decisions we can with the best information available at the time. Today, we're going to look at many of the best and brightest forecasts from around the world, debate their ideas, and stress test their assumptions. On the agenda, we're going to look at the economic, geopolitical, and investment predictions from around the world. Then, as always, at the end, we'll explore the investment implications. Today, as always, I want to welcome the co-founder and chief investment officer at Nucleus Wealth, Damien Klassen. Great to have you back after the festive season.
Yeah, good to be here, Sam.
Excellent. So today we also have Nucleus Wealth's other co-founder and our chief strategist, David Smith. Dave, welcome back to 2023.
Hi, Sam. I'm just developing a problem with my headphones. Can we go without?
Yeah, sure. We're just going to have to roll with it.
All right.
Okay.
Sorry, the jack is broken. Anyway.
All good. We will carry on. My name's Sam Kerr. I'm the Senior Financial Advisor at Nucleus Wealth. And for those listeners that don't know, Nucleus Wealth is an Australian active and passive investment manager. We're a global macro investment house and use the insights shared in this podcast to construct and manage our active portfolios. We're also the first to offer passive direct indexing in Australia, which has been labelled ETFs 2.0, as you can customise your chosen index with around 50 different ethical, sector and asset class screens that we have on offer across all our portfolios. Just a quick housekeeping message. If you enjoy our content, please subscribe to our YouTube channel and click the bell below to be notified when we go live or have a new episode recorded. We are live every Thursday at 12:30 Sydney, Melbourne time. So jump onto the Nucleus Wealth YouTube channel and you can ask any questions that come to mind and we'll do our best to answer them during the show. You can also follow us on your preferred podcast platform as our show is available on all the majors. And if you'd like to see the slides in more detail, we will post them in the show notes this afternoon and you can view these at nucleuswealth.com/webinars. So now we've got that housekeeping out of the way. Damo, over to you to get us started.
Yeah, sure. So we're going to kick off with I actually got it back to front. We're going to kick off with some geopolitical stuff for 2023, and we'll run through a couple of our favourite analysts and see what they think the upsides and down are. Kicking off with everybody's favourite mega bear, Dr. Doom, Nouriel Roubini, who's recently published a new book about mega threats, and he's been putting forth some very bearish material in the press as well, citing a number of different risks for the long term and to come to bear in the next year. The first sort of category of which is military conflicts, the risk of some kind of intensification of the NATO-Russian war, particularly if Russia were to go nuclear. I don't think this is likely. It's obviously a tail risk. In fact, from what we're reading, the Russian military is looking pretty exhausted. The Ukraine is probably likely to make more incremental gains, and the whole thing is more in something of a stalemate and stagnation rather than a scenario of intensification. So obviously something to watch, but not as concerned about it as Mr. Roubini. Anything you want to add on that, Damo?
Well, I guess, I mean, because there's a lot of people sort of making assessments on the Ukraine war and where it's headed to. I think that the safe for most people is stalemate, and that's sort of where a lot of them sort of land. I think, as I said, our key is that it does look as if the Ukraine's making more incremental gains than Russia, and the incremental gains Russia makes look to be more symbolic than tactical. And I think there's I think there's also supply chain issues that Russia's having. So, while stalemate is a fair enough assessment, I think if you were going to sort of handicap and say, well, is there a chance that the Ukraine could do another few leapfrogs and take back sort of large swathes of territory? I'd say, yeah, look, that seems more likely than the other way around at the moment. And I'm sorry, and actually, just on the NATO being dragged in, that seems unlikely. It seems, given the state of the Russian military, I think the last thing they want is to open up any new battles or include anyone else new in the fight. And so, yeah, I think that's a very much a tail risk rather than a major issue.
It's serving any NATO members' interests either.
No.
It's much more comfortable for them as a proxy war in political terms.
Yes, yeah, exactly. But I do think you'll sort of see that. I do think what you'll see is a continued supply of weapons to the Ukraine. Sort of keeps them sort of at that stage. Keeps them sort of in a much better position than Russia. And the other thing to keep watching for is any signs of instability in Russia. I don't think there are any major ones, but I think there's obviously not everyone wants to be in the war, and some want to be in the war, but more, and so it's a and I think there was this sort of 23 billionaires or something like that have died in mysterious circumstances in the last year in Russia. So it's worth keeping an eye on sort of domestic instability in Russia as well sometimes.
So China invades Taiwan. I don't think that's imminent. And in fact, I really don't see the reason to do it at all. And what we can say is that there are increasing reasons not to do it, or increasing deterrence with the US, pretty heavily engaged in a Cold War against China, which is taking on some pretty significant economic dimensions. And I think that the obvious next phase in that is that it builds into what becomes a standing threat for China. If it were to try to annex Taiwan, it would face a similar, if not worse, considerably worse sanctions regime than Russia has, which would basically destroy its economy.
And I guess the point is, it doesn't even need to be a worse than the Russian one, even if it's just anywhere in the same ballpark. Yes. China's so much more integrated in the world economy that it's going to be so much more effective.
And with enormous reserves that would disappear, and then even more importantly, enormous sources of demand for its industrial overcapacity, which would leave a lot of unhappy, unemployed Chinese for the CCP to deal with. So see more rise of deterrence than rise of prospect on that front in the short and even medium and long term. So not concerned about that one for 2023. Iran and North Korea are always with us, so that's a bit of a big yawn, that one. Someone may bomb Iran and North Korea is certain to fire some missiles, but that's not going to disrupt anything. Deglobalization, sovereign debt crisis, stagflation. Of these, the stagflation and sovereign debt crisis are the ones that are perhaps most pertinent for 2023. Rubini is mounting the argument that we're in for a very severe and lengthy global recession, perhaps especially for developed markets, because of the huge debt loads in private and especially public sectors, and then rising interest rates making those untenable in repayment terms, leading to central banks folding on their tightening, and so leaving inflation in place. Perhaps over the longer term, don't see it. Excuse me.
Yeah.
Well, I've got someone at the door.
Yeah, sure. Yeah. So on the shorter term, I think that's I guess what we're looking at from that perspective is yes, there's deflationary pressures. So it's sort of and you've got the you've got these rising interest rates, and so I guess what we're positing is, look, it's pretty hard to have stagflation and sovereign debt crises and deep recessions all at the same time. If there's an argument for stagflation, that argument needs to come in the next boom, in terms of it being, yes, you get deflation first, and then as you're coming out of that, and if there's extra stimulus thrown at it, you might end up back in the same or back in a similar situation where you're getting high inflation again and potentially lower employment at the time. So that's I guess that's a problem for 2024 or 2025, not a problem for 2023. I think in terms of the deglobalization, look, it's an interesting one, the deglobalization. Look, there's certainly it's certainly happening. The question is it happening more? Are there, there's always parts of globalization, and there's always parts of deglobalization, like going on at any one point in time, and some of it, you can get some high profile ones where people are moving production out of China, but there's also, if you dig into it, there's a fair few where it's moving into China as well. I mean, just an example is Panasonic. The other day, somebody was, one of the Japanese manufacturers is now finally stopping, manufacturing rice cookers in Japan, and they're outsourcing it all to China. And so it's not a completely one way, but and some of it is, economically driven. And so, yes, it's being shut down in China because the prices are too high and it's moved to Vietnam, or it's shut down in China and moved to Bangladesh, or whatever it is. And so, in which case, it's not really deglobalization as much as, China's sort of benefiting from, or China's losing out due to rising costs and rising wages there. So, I think there's, you can sort of pick your story out of that, but I think there's some of them are at odds to each other.
Yeah, I'd simply say I expect a year of pretty heavy-duty disinflation, even deflation in developed markets. We've already got it in a number of emerging markets. So, and I expect growth to be quite troubled as well, but I don't think it's a year where those are not the kind of dynamics that you're going to end up with a debt crisis. A sovereign debt crisis. So I agree with you on that. And where you do have sporadic outbreaks of it, such as we've seen in the UK, then the answer will probably be yield curve control of some sort, so central banks can get a handle on it. And then it would be an issue of longer term inflation. So that would come to bear before too long in terms of asset allocation questions, but for the time being, it's really the cycle that matters, not those structural forces, I think. Climate change, obviously, always with us, so not particularly worried about it this year.
What was Rubini's point on that one again? What was
that's just another one of structural mega threat,
right?
Yeah, needs to be addressed, and I guess we could say that the energy shock we've been through has been a short-term boost to climate change mitigation. I guess short-term boost.
Short-term negative.
Longer term.
Yeah, probably medium-term boost.
Medium-term boost for climate change mitigation. Pandemics was another one, and economic inequity was another that he mentioned. But I mean, all of these things that we've had with us forever, and so I really don't see most of them as mega threats at all. Most, except perhaps climate change, but again, structural, long-term, not 2023. So geopolitics, if anything, I think may calm down a little this year, because some of the intense fallouts, particularly from the war in Ukraine, are really starting to settle, if anything, more quickly than anyone imagined, thanks to warm weather in the Northern Hemisphere by and large. We're starting to see, the beginning of the end of the energy shock. So in geopolitics, I'm not overly concerned.
Yeah, so maybe we can move on to Zoltan.
Yeah.
Yeah. So Zoltan came out with a piece on Bretton Woods 3. So and so he came out with that last year, and there's been a lot of talk about the whole end of US dollar hegemony, and but I guess his basic thesis is that what you'll see is the world will splinter into a China Russia centric part and a Western centric part, and that what you'll see is that commodities will be the new sort of global currency, and so everything. What will matter is currencies priced in terms of commodities, unless not so much gold, but while gold will play a part, but more about I guess the more useful commodities in terms of copper and oil and gas, and so. And I guess his take then, so that sort of leads to this rise of the Chushan commodity regime, where China has a lot of goods and a lot of production. Russia has a lot of raw commodities, and the two will work together, and that they won't need, I guess, the rest of the world as much. And actually, the rest of the world will be beholden to these two countries that sort of contain all the production and the energy that the rest of the world needs. And so that sort of leads then to less demand for the US dollar, so higher, lower US dollar. It also leads to higher yields because there's less demand for US bonds, and potentially inflation as well. So that's sort of his thesis. I guess I'll let you first at it, Dave, before you get interrupted again.
Well, I think Michael Pettis has done the best job of comprehensively demolishing this argument. If principally because the structure of the balance of payments in China means that it has to export its capital, because it overproduces, keeps wages artificially low, all sorts of incentives to invest in production over demand, demand. And there's very few places that dough can go. It's really Europe and the US have the deep enough and most liquid kind of debt markets. And so for this kind of regime to take hold, the Chinese economy would have to restructure entirely towards domestic demand, or a great deal from what it is today. And there's no prospect of them doing that as their demographics fall apart. So, be careful what you wish for, I guess, is in the case of China. If you really want to have, a yuan hegemony, it's kind of committing suicide for the structure of the Chinese economy. So it's self-defeating in a way.
Can I explain that in a slightly different way? Is that the argument sort of either goes one of two directions. One is that it says the US and Western countries are over consuming and they have to borrow from China in order to be able to consume, and so China gets to provide the goods and they get to provide the capital as well. And it's all the Western countries' fault for spending too much money and going into debt when they shouldn't. They should be more austere and live within their means. So that's one side of it. The other side says, which is the Pettis view, is that actually we're not capital constrained. Capital we were capital constrained in the 1950s and 60s, and so those arguments sort of stacked up then. But we're not actually capital constrained at the moment. We've actually got too much capital washing around, and so what's happening is these are just accounting identities. Is that China's keeping its so China sells goods to the US, and rather than bringing back the money, they're investing in US treasuries or US whatever they can in the US, the equities and everything like that now as well, wherever they can. And so what that means is that the Chinese yuan stays lower because they haven't brought the money back, and China's exported both the capital. So it's actually more of a matter of China not wanting to bring the capital back, wanting to leave it overseas. And so the natural result of that is that US has been given all this extra capital, and the goods have been kept low. Goods prices have been kept low because they haven't brought it back. And so the whole thing's added up to the US, taking in extra capital and the goods, and so therefore, as an accounting identity, they have to increase the liabilities back to other countries. And so, and under that regime, what actually matters is not who can produce goods at the lowest cost and force them out. It's actually who's got the demand to actually buy those goods. Because if China says, oh, no, we're not going to sell goods to the US, there's 20 or 30% of their population unemployed overnight, because what other country is going to take the amount of goods that China wants to produce? And if China says, no, we're going to bring all the capital back to we're not going to have that capital in the US anymore, we're going to bring it all back to China, well, the yuan shoots higher because all that money, this massive wave of money comes back to China, and all of a sudden the yuan goes higher, and its goods are no longer cheap. It's they're all back to sort of on par with other ones. And so that's effectively the Pettis argument is you can either have you either say that the person who's keeping their currency low and overproducing and exporting capital, they have all the power, or the country with the demand and with the demand to buy the goods and open capital markets, they have the power. And we're very much in that second camp, is that we don't think you could end up in this scenario. And it's worth saying as well, Zoltan is very, very good on the plumbing of global markets. Like that's where he really made his name, was in terms of the arcane details of repos and how it all fits together, and when things when the market starts seizing up, and what the right remedies are to stop these markets seizing up. So he hasn't sort of come from a geopolitical point of view and more of an economic point of view as well. So I think he's approaching this from a plumbing point of view, and I don't think we're siding certainly with the Pettis in terms of our view of the outcomes.
That said, at the margin, I think he's right. So we will see this integration of Russia and China create some kind of new monetary system and cycle, I think, and that may spill over into a little bit of commodities bid and may have implication for some currencies and gold and stuff. So I'm not saying this isn't going to happen, just that it's more marginal, and
he's drawing quite a long conclusion. He's just sort of saying yes, it's going to go from 1 to 3, and therefore then it must also go to 10. Whereas we're going, it'll go from 1 to 3, sure. It might even make 4 or 5, but it's not going to 10.
Yeah. So in other words, we see actually a relatively benign geopolitical year in 2023. Certainly those risks are still there, but not an intensification. If anything, the opposite. So in our next category, which was economic, we're going to have a look at a couple of lists put out by some big brands, and the first one being the Economist, that is forecasting recessions in developed markets. So recessions loom, US mild, Europe brutal. I mean, I actually think it'll be sort of mild to moderate in the US and probably similar in Europe. It's coming out of its energy crisis, at least until next winter, and arguably because this winter has been so warm and its inventories are so high of gas, for instance, the rebuild for next winter will be a hell of a lot easier. And there's more LNG coming on stream this year before then as well. Some
more import terminals for US gas.
Import terminals, so they'll be better prepared. And they've got another 12 months to sort of prepare policy for any demand destruction or limits that they need to do. So I mean, I'm almost to the point of concluding that the European energy crisis is effectively over.
I guess one slight disclaimer to that is, look, I think it's subject to weather.
Subject to weather. We've got probably another 6 weeks where it could get cold.
But I guess I'm talking next winter. If you had a really brutal winter.
If you had a really brutal winter, yes. But even then, I don't think we'd see the sort of prices we saw last year.
No.
And it'd be brief. But that would be material. Yes. So that's
and I think it's the following year where the supply really ramps up, particularly from the US. And
it keeps coming. Yes. So climate silver lining, we've
so before you do that, the soaring food prices. I mean, this is an interesting one in that retail food prices are still sort of heading up, or there's still a reasonable amount of inflation in retail food prices. Wholesale ones, so the UN sort of food price index turned down 2 or 3 months ago, and it's actually tumbling.
It is.
And so there's a little bit of a disconnect here where I actually would have thought already we would have started seeing that sort of flow through to food prices. But there's certainly, certainly something going on here, whether it's just more of a delay and we will see that food come off quite sharply.
I think it's a delay. I mean, we've now got a global glut in wheat that's coming out of absolutely everywhere. And probably the big component of this is actually the collapse in global gas price, which is then flowing through to fertilizers and what have you. Now there will still be some inflationary pressures in there. There's quite a backlog on farm machinery and things like that, but definitely past the peak for food prices too. So that should be deflationary through the year. Therefore, half agree with the Economist's first point. Climate silver lining, yes, agree. That's going to be good for climate, the whole.
Yeah, so what they're saying is effectively there's a rush back to fossil fuels, but in the medium term it's better, and that's exactly our plan. And I guess I'd argue that I don't think it's not a short term issue. It's not a 2023 issue. It's probably more of a 2030 issue or something, or over the next 4 or 5 years at least. Is that there's a pretty reasonable chance I think we'll actually get too much in the way of in that we'll actually see countries really ramp up the amount of the amount that they're putting into renewables, and I guess the take there is that the analogy for me is you saw these railroad booms in the 1800s, or you saw the tech boom and all the everyone building as much internet cables as they could, and I feel that's where we are in sort of the renewable energy, is that whoever can build stuff is building stuff, and there's probably going to be some, if you're one of the ones investing in the companies that are actually making this, depending upon what you're doing, if you're providing services, you can do well. If you're betting on your company will have the next latest and greatest technology, or I'd be a little bit more circumspect, because I do think you're going to find there'll be parts of oversupply, but it will be very beneficial for the world economy. So picking the right companies, there might be issues, but the net effect of the railroad boom was, yes, there was a lot of money lost by people who invested in these things, but all these countries got these fantastic railway systems because of the competition and that, and similar with the internet. We've got all these great internet infrastructure built. Yes, a bunch of companies blew up and wasted all this shareholder capital, but the actual benefit for the world was significant. And so, keeping an eye on making sure that whatever you're doing in that renewable energy part is you're not sort of ending up in the companies that might end up being in parts of oversupply.
Peak China, definitely.
Yeah. So
we've had all sorts of revisions to their demographics, all of them very bad. I'm not sure if India overtakes. I don't track India's population, but I can say with the Chinese reopening this year, and the sort of immediate question, especially for our Australian listeners, is the peak Chinese demographics really going to damage residential construction and infrastructure building, such that Australia's hard commodities are affected. We have this Chinese reopening, and at the moment they're all rallying, but I actually don't think that's going to get overly far. We think that the recent residential shakeout that went for 2 years or so is going to leave some structural scars, and so it'll be difficult for households to be coaxed into borrowing at scale in the way they have previously, not to mention the various developers that have had near-death experiences over the last 2 years, and the idea of leveraging up into another mood shift by Xi Jinping can't be all that appealing. So, we think that the peak Chinese demographics and construction is past, and I actually think it'll be kind of L-shaped this year. Some rebound in residential, but infrastructure falling away, because last year was just so huge. The amount of infrastructure, it's kind of inevitably got to fall. So those two probably offsetting one another. And the rebound's likely to be consumer-led, not investment-led. Good. Don't get me wrong, I think V-shaped recovery for the consumer and decent overall growth, but much less commodity intensive than the market is probably assuming at the moment, and that is all part of the peak China story. So agree with that.
Yeah, and I guess the other thing to come out of this is that China's hasn't really been in lockdown for longer than everyone. Like China was sort of, yes, they've been doing rolling lockdowns and stuff like that, but I guess you've already had a bit of a reopening boom in terms of China, in terms of yes, they had the initial lockdowns and they came out, and you already had the bit of that. Yes, okay, there's a lot of people who want to buy bigger places or get out of an apartment and into a house, and there's all these other things that happen and buy more goods and that type of stuff that went on that we saw elsewhere. And so they've already had that. They'll probably have another one, but it's likely to be an echo of the first one. It's not likely to be as large. And then the other the other factor in terms of peak China, I think the Indian population is going to overtake it, based on demographic growth, which is effectively what they're relying on anyway. It's going to be around about April, May. And so you're probably going to see a lot of, I guess there'll be a lot of pontificating in the press, I think, about the whole, is this the end of China? They're finally no longer the number one, and, all that type of stuff like that. And so, even if there's regardless of what the truth is, there's going to be a fair bit of, discussion anyway about that, which can obviously affect sentiment. That was one. And the other one on the reopening one for China is, the question with China for me is that given Xi has been consolidating a lot more power, and that's been the real signature of his regime has been that the prior administration was sort of trying to disperse power a little bit, and he's drawing it back into the center. And what it means for local government officials is that it's very hard for them to make decisions without knowing for sure what Xi wants. And so there's a few things where, for example, he's dropped the 3 red lines, and he's dropped they're talking about softening the 3 red lines, and he's dropped the comments about houses are for living, not for speculation. Now, the market sort of read that as being it's back on. We're into a housing boom, and they're all going to get out and build lots more houses, and we'll be back to where we were a few years ago. My take is that you're going to need to see, and it may happen, but you're going to need some explicit instruction from central governments to actually say to local, no, we want you, yes, we told you to pull back on the debt and not to cross the 3 red lines and to pull back on the housing, but now we've changed our mind and we want you to do exactly the opposite. Because while you can read the tea leaves and say, well, that's what's coming next, I don't think the local government authorities are going to want to sort of do something that they know was opposite to what Xi wanted until they've actually clearly been told this is what they have to do. Revenge tourism.
Is this the revenge of tourism, or is there such?
Well, it's people saying I've been shut down for a few years and now I can get out and spend money.
So it is the revenge of tourism.
Yeah. Well, and I think this is true for
you're not going to travel for the purposes of ending a blood feud.
No, I think it was more about saying I need to get out and see I haven't been out of the country for a few years. I need to get out and do it.
Yeah. Well, I think that's a certainty, isn't it?
Yeah, but I think it's already been happening to a certain extent. I think it's probably more so from China, and that's probably the one that's probably a slight negative for China in the sense of if they send a lot of people overseas, and
a positive for Australia though.
Yeah. Yep. If China sends a lot of people overseas, and then there's a lot of money flowing out of China and into other countries.
Yeah. Metaverse reality check. Well, we're already there, aren't we? I mean, Meta is kind of halfway through turning the oil tanker.
Yeah, it's hard to tell. It's hard to tell. So, I mean, I think they've certainly bought in on the idea that, and just to put this in perspective, I guess the way I think about the metaverse is really about saying, okay, are you going to hang out in virtual world with your mates, and so if you're playing computer games or you're playing playing card games online or something like that, will you do it in like a in a virtual sort of world with your friends or strangers from the other side of the world that you're playing with, or is that a pipe dream and it's not really going to catch on? Now, Meta's been spending a bucket loads of money on this, too much money, quite frankly. The question, they've been winding that back. I don't think in my view, they're still going for it. They're just not saying, at the moment they were losing money. They're basically saying, we're making this fortune from advertising, and we're going to blow the lot plus more on trying to set up this Meta, trying to get in front on the whole virtual reality side. They've now gone back to the part of going, okay, maybe we shouldn't be spending everything we make plus more. Maybe we should just be spending, a significant chunk. Apple's launching a headset this year. I don't know. It's a tough one. It's Meta, but I think it's well worth looking at to see what happens within this. The VR has sort of been touted as this great thing several times over the last 20 or 30 years, and it's going to all of a sudden take off. It never has to date, but it does seem as if technology has caught up, at least to close to where it wants to be. Still hard to tell if it's is this the year? Is this the year it's going to make some big sudden strides? I don't know. Maybe not. It'd be interesting to see what Apple's does. My expectation would be this isn't the year, but you want to be looking for trying to read the tea leaves.
So Ukraine grinding stalemate. I guess we more or less agree with that. West of the world affected by energy prices, but actually getting better, not worse. I think inflation is clearly topped out in the US. I think it'll be topped out here shortly as well. Interest rates, a little bit left in the Fed. And the RBA is almost done, if it has any sense. We think economic growth will be troubled for 6 months or so, especially in DMs, 6 to 9 months. And we think food's going to get cheaper. Divided America. We don't have anything of particular political interest this year in America, do we? In terms of milestone possible rally points.
I don't think so. No, and I think you've sort of
think so.
Yeah, you've sort of done most of the stuff they wanted. They were, I guess, assuming that they're not going to be able to get stuff through both houses. But I guess there's also a divided Republican Party, so it's not.
Well, we're going to have a debt ceiling debacle of some sort very soon.
Yes.
So that could be market moving if the Republicans really decide to, menace the budget, which they probably will. So that's something to watch.
Well, and I guess so as well. There's obviously the group of 20 that were sort of blocking McCarthy being put through as speaker that are very much on the whole debt side. But the question as well is, that the Democrats only need to peel off, 5 votes, maybe 10, and they can get something through. So, be interested to see how united the Republicans stand.
Yeah. Flashpoints, we've been through those really. We're not overly.
Well, we didn't. India, China, and Turkey.
Greek Island.
Yeah.
I mean, that they need to avenge Troy, don't they? So S&P Global has a list of their own. So this is a big one. Global monetary policy tightening further to go to spring 2023. Yes, especially the ECB, somewhat the Fed. Tonight's CPI will play some role in that. But the Fed's been fairly strident in saying they don't want to pull an Arthur Burns. That is, they want to stop too early. Allow what is still relatively robust core inflation to stay in place.
Well, as I said, David, the new word supercore inflation.
Supercore
inflation, which is effectively services inflation minus housing. Yeah.
Right. They will be focused on that to some extent, and there is a little bit more tightening coming, but I think peak rates around 5% is sort of roughly a fair bet. And as I said, the RBA may go one more or may go two more. I don't know, but I think you should stop. I think it's got enough embedded with the fixed rate reset coming to absolutely steamroll consumption. So Australia's going to see its labour market loosening throughout this year as a result on what the RBA has already done. And it's also got the good news of what the Albanese government has done with energy prices, which has averted nearly all of the shock that transpired last year. In fact, pretty much all of it, because most of it, other than in New South Wales, hadn't flowed through yet owing to state government subsidies. And I imagine they'll be held in place until the wholesale prices flow through. And so most people will never see it. So that's a huge burden off the RBA's back. And so, yes, I think they're close to pausing. And I also think that they'll be forced to cut harder than just about anyone else before the end of the year, because once the fixed rate reset kicks in and really damages consumption, you can't have falling house prices at the same time. I mean, you'll really be threatening to overthrow household sentiment into some kind of abyss. So I think that the RBA will have to charge in with relief later in 2023.
I just want to that sort of goes a little bit to this idea of change versus level, and I think with everything, it's a mixture. Everything's a mixture of both change and level. So, and what I mean by that is, okay, does it matter that interest rates are going to be 6 or 7%? Home loan rates can be 6 or 7%, and you go, well, we had that, 10 years ago. It's, surely we can handle it again without a recession. And you're like, well, yeah, but it's a change. It's a sudden change going from 2% to 7%, overnight. And so there's that sort of mix of it. And that sort of flows through into a whole bunch of other factors as well. But and employment's a similar one in terms of, yes, does it matter that employment's quite low, or is it actually the change in unemployment of a bunch of people losing their job? That's what's going to be causing the economic weakness. And one of the ones which I'm keeping, they don't have on this, but it, I'm certainly of great interest to me is the company insolvencies, because they are all starting to increase. They're sort of, but right around the world, countries all put on these measures to stop companies from going broke, and we are going to see this big lift now. At the moment, it's not really an above average. It's sort of big lift from low to average is going on, but it's only really just starting. And so, how much of an effect that's going to have on economies as well is going to be, is one of my key things to watch for.
Housing markets continue to weaken. Yes. Rising mortgage rate, well, not by much more, because houses are already weakening very fast in Australia and equally fast in the US. Now, US dollar has likely peaked and will retreat in 2023. Yes, I agree with that, with the caveat that given we see recessions in both the US and Europe sometime over the next 6 months, then I think that would be sufficient to put a safe haven bid into the US dollar, especially given we think that these recessions, although not severe, will be very damaging to corporate profits, because margins have been so wide, in fact, record margins across the S&P 500 will get slaughtered by falling inflation at the same time. And so you're likely to see we think that you'll see quite high volatility in the equity market, and that's likely to put a bid in the US dollar for a little while. So I think the peak's in, but we're going to have a bid at some point as well, we think. So, another mini boom in the US dollar on the way down. Mainland China easing of containment policies propelled choppy recovery. Yeah, more or less right. Discussed that. Consumer-led, with investment diminishing. And of course, if we get these recessions in DMs, then they'll be wrestling with a trade shock as well. So choppy is probably the word. I mean, I think V-shaped for the consumer, but dealing with some other headwinds. Supply chain disruptions to ease markedly, absolutely.
Yeah, I feel like this one, they're sort of basically describing what's already happened, the supply chain. Like that's where we are now.
Yes.
Yeah, but I do think if things progress the way we're expecting, the labour shortages aren't going to remain. They're going to come pretty quick. Yeah.
No, I wouldn't expect like a catastrophe for labour markets, but a material move up in unemployment. And labour shortage to remain a challenge, even as unemployment is predicted to rise modestly. Well, I mean, perhaps in the US, perhaps because they've had such a drop in participation and lots of people retiring out of COVID because they didn't really treat anyone with any kind of life expectancy dignity. That said, I didn't really enjoy 2 years of lockdowns in Australia, so there was no perfect solution. But there are always labour shortage problems. If you ask business, there will be more labour in 2023. So that's our basic background. Now we wanted to go through, some of the top strategists. Some of these are our favourites and others less so, but it's a sort of mix of bulls and bears.
Yep.
Probably a little bit more on the bearish side. I haven't been following Rosenberg that much. Damo, do you want to take him?
Yeah, so he's basically saying deflation's your problem at the moment. He's basically saying, look, all your monetary aggregates. So this central banks have turned, when they had the taps turned on, you worry about inflation. When they turn the taps off, now you got to be worried about deflation. And that given the recessions that are likely to occur, if not already occurring, that deflation is going to be a much bigger problem than inflation. He's saying corporate earnings, when you hit recessions, corporate earnings tend to fall by about 20%. Corporate earnings have still got growth factored in, just small levels of growth, but I think it's 3 or 4% for 2023. So, I guess I'd be thinking, my rough take is, there's probably 10% to come out of earnings for 2023 and another 10 for 2024. Or I guess if you did it to a junior end, the junior end 2024, like in 6 months' time, you might see those earnings, the forward earnings down 20%. I think is a reasonable assumption to make. His thoughts are that, look, there's housing bubble risks, but it's as all these interest rates rise and a lot of countries had the booms in house prices, but it's unlikely to sort of turn into a 2008 housing crisis because banks are better capitalized and there hasn't been as much poor lending that we saw, poor lending standards. So so for me, most of those sound pretty reasonable.
Yeah, I agree with all of them. Michael Hartnett, BofA, who had an excellent year last year, he's calling major bond boom in the first half of the year and similar scale correction in equities. China emerging markets lift on the reopening and excuse me, and they're a little bit further on in their tightening cycles as well. So some of them are more able to ease. Structural shift to deglobalization, fiscal spending to fight inequity. War means inflation, small caps, industrials and commodities. So our jury is still out on these structural shifts to higher inflation and interest rates. And this year we don't think it is a huge year to worry about. As said, I think it's going to be a very big disinflationary year. Not saying they're not going to happen. They clearly, some of these things are happening. What their impact is, remains to be seen. And there are lots of deflationary problems to offset them, including China shifting X growth, even if it rebounds to a decent this year could contain commodity prices pretty easily, or would if it happens, if it downshifts to sort of 3% growth and is much less investment oriented. Is fiscal spending and MMT now going to be condemned after an inflationary burst in the pandemic and we go back to austerity possible? don't know.
Yeah, so this is the argument, isn't it, David? You either fall into one or two camps. You go, hey, we were about to go into this massive downturn. We threw all this money at consumers and businesses, and it lifted us out. And so therefore that's the thing to do. If we have one of these, we've got to do that again.
Well, AMT actually worked precisely as
advertised.
As advertised.
Yeah, but the flip side is saying, oh, no, that was terrible. We threw all this money at businesses and people, and inflation got out of control.
Yeah.
And so, I guess it's either, do you take the lesson out of that is actually it worked too well? Maybe we don't need to throw as much money. We should still throw the money, but maybe we don't need to throw as much next time. Or you say, no, that was terrible. We should never do that again. We should have just taken the austerity. And I feel like the first will be the answer, is that, and maybe they'll get it wrong again on the, on doing too much. And therefore we're back into inflation. If they don't get it, if they don't spend enough, then we're back in our disinflation world.
Yeah, that's probably the swing factor in all of this. War to persist for the time being.
Actually, can I talk quickly deglobalization as well? Just the other one I should have mentioned on deglobalization is it's this issue about, does it increase costs and inflation? And so in the medium term, I think it actually locks us into lower inflation. So if you take a factory out of China, you automate it, stick it in the US, now you've got a capital cost you got to keep up. So most of your money now is in machines, and the machines get cheaper every year or more efficient, and you gradually get better. And so you're actually into a deflationary thing. And so, but the thing is, are you going to increase costs in the short term? So does it go from costing $100 a unit to costing $120 a unit in the US? And I guess my argument is, look, no. Is that what is happening is, if it's $100 to produce it in China, and you can do it automated in the US for $102 or $105 or something like that, yeah, sure, companies will do it with a view that they'll get that benefit over the longer term. But if it's going from 100 to 120, the companies just simply aren't doing it. They're just, they might take it out of China, but then they're sticking it in Mexico, or they're taking it out of China and sticking it in Vietnam or somewhere else. If they want to try and diversify their supply chain and get better, get more resiliency within that, is that it's not the argument that we're automatically going to pay more, I think ignores the fact that if that's the case, we actually need you need a whole raft of tariffs and all these things like that to convince companies that this is the thing to do, because companies aren't going to do it of their own volition. No company is going to sit there and say, okay, I want to be really resilient, and I don't want, I want to make sure that the US has got enough, whatever of that, and so I'm going to have a much higher cost than all my competitors in order to, bring everything on shore. Whereas, I think there's a much better case for this deglobalization to be. It might be a de-Chinification, but it may not be as de-global as you might think.
No, friendshoring is the
friendshoring.
Yes. There are lots of cheap jurisdictions within the within the US and European spheres of influence. So, you may well see some of those, or definitely going to see some coming out of China, and Apple's kind of doing some more of that today. They're pulling out of Korea and bringing their screens home. So, yes, some more of that. So next strategist, Michael Wilson, who also had a brilliant 2022, and we're quite fond of his work. As a 3,000 target on the S&P 500, so roughly 1,000 points below. MSC's inflation peaking and falling pretty quick, but they see that as very negative for earnings, and we agree with that thesis. In fact, when you look at corporate profits in terms of the business cycle, it's actually the bottom line where most of the pain is in recessions, even mild recessions. It's not the top line. It's not the damage to sales. Obviously, there's some. It's the damage to margins that kills corporate profits. And because margins have been so extended by inflation, they're going to mean revert and overshoot to the downside. So that's the thesis we buy, and at the same time, the equity risk premium is likely to spike, and so he sees pretty good downgrading equities ahead, probably in the first half of 2023. Timing, of course, is always a tricky issue, but we agree with the thesis.
The bulls.
And just to offset that battery of bears, we have some bulls. They're not actually that easy to find in Wall Street strategists. There are a couple. Goldman Sachs, of course, is the leading bull. It always is. So they think that the US will avoid a recession. It will be a soft landing. That the Fed will engineer a reduction in job ads, not jobs, particularly. And so, their outlook for US stocks is relatively benign. It's not bullish particularly because it's a landing, even if it's soft. But they're very bullish on China and in particular commodities. I think most commodities are in a super cycle, owing in large part to underinvestment for a number of reasons, leaving us, short of supply in base metals, especially oil, and stuff, which, some of the arguments in some of the commodities stack up and others don't. We see a sort of cyclical bounce for commodities on restocking into China, and that will include some base metals such as aluminium and copper, etc., and iron ore, and probably oil as well. But we also see some fairly significant headwinds, coming out of these recessionary conditions. So not really enamored of those arguments, but they are out there, and not impossible by any means. We could see a soft landing. My main argument against it is, well, probably two. One, such a quick spike in interest rates, slamming into unprecedented debt stocks is a pretty convincing argument for a recession. And the other one is just the bond market. What it's telling us in the US, with heavily inverted yield curve, which has a very good record of forecasting recessions. So I'm on board with that. JP Morgan, they were also very bullish on the US all last year and were wrong in terms of stocks, but eventually rolled over late last year and now see a US recession, and so not particularly bullish stocks, but are very bullish on China, like Goldman, but at the same time are now, having been bullish Europe, are calling a sell on Europe because that's run very far, largely on further ECB tightening. So they more or less see downturns in both the US and Europe, which is kind of, our base case as well. And I pretty much agree with them on China. I do think that the reopening in China, from all of the reopenings we've seen, you get so much short-term domestic momentum that it's likely that China can see off the worst of a DM, or developed market downturn for its asset markets, so it would probably be okay. And its equity market has rebounded aggressively, but it's still relatively cheap. So there is a pretty good argument to buy China. Finally, we'll bring it home and what we think is coming for Australia. And I guess these are our views. That kind of concludes our wrap up of various lists and outlooks. For Australia, we're going to give you the Nucleus Wealth outlook, which is, we're kind of 1 or 2 quarters lagging the US, thanks largely to a later reopening from COVID. Of the view that the RBA has already gone too far, and given that so much of its potential tightening has been delayed by the fixed rate reset, and then will arrive all in one go over the next 6 months, 9 months, and will come in the form of cliffs instead of incremental tightening. That means that, discretionary income is going to get hammered for a lot of mortgage holders. And so we see consumption taking a pretty nasty hit. Historic house price bust to continue. Pick a number, 15, 20%. Probably a per capita recession of some kind. Banks, we think, Aussie banks in trouble, like some of the banks in the other countries, but we think Aussie banks are going to be on the nose in terms of bad debt.
And they're so much more expensive than the
and they're wildly expensive. Yes, so not interested in Aussie banks except perhaps as a short play. They're not forecasting a catastrophe or anything for the banks, but certainly they're going to see a material rise in provisions as house prices keep falling, unemployment comes up. And maybe more distressed sales than we've seen in Australia for some time in terms of houses. That should be enough to more than offset any increase in margins that they've enjoyed, through the rate cycle. China, some offset in tourism and students from China. But as already argued, expect commodities to actually fade in some ways quite sharply. I think the LNG has already crashed back into historical ranges, high end of those ranges, and coal's the next one to go. Coal will go where LNG goes. That's thermal coal, and those two got so high that is a huge blow to the terms of trade. So that's quite an income negative. Tourism students good, but at the same time, Aussies are all flooding out of the country to travel as well. So that's kind of swings and roundabouts. It will probably be a little bit positive in net terms, given the Aussies have been flowing out a bit before the Chinese will flow in.
But it's also the argument that that Leith makes all the time on the blog is that student income, there's two ways of counting it. One is you say, here's a student who spent $100,000 over 2 years on staying alive, or over 3 years on staying alive and university degrees and all that type of stuff, and the other one is saying, well, actually they earned most of the money here working as an Uber Eats driver, and they're just taking the money they're making on one side and putting it back into staying alive and everything. So is it really an export, or is it just put somebody in and
No, it's not, but it adds to GDP. Right?
It does add to GDP, yes.
I'm not sure. I'm only talking GDP terms there, not standard of living.
Yeah.
I think the standards of living are going to fall this year.
Well, and that's the issue for wages, isn't it, in Australia? Is it typically when we open the floodgates to international students, it keeps wages down?
Yes. So, we expect that to happen. We've discussed the good news on energy. Floods have passed, so that's going to help with food downside. And interestingly, yesterday's monthly CPI was very goods-driven inflation still. And that, so what's coming down the pipe globally on that front, we'll see, inflation fall quite sharply once we get past the peak, which we're roughly at right now.
Yeah, and some of that's just going to be inflated. It's just the Aussie dollar though as well, wasn't it? Because the Aussie dollar fell from low 70s down to the mid 60s. So the Aussie dollar fell 10% sort of last year into that.
Yeah, more even, nearly 20, like 15 or so, and it's now recovered a lot of that. So
so it's all
So yeah, I mean, not a great year for Australia, and probably. If it wasn't for immigration, it'd probably be a recession, but immigration makes it difficult to get negative GDP. So, if it's running at 2%, then you've kind of got 2% growth before you even start. So, and it may get as high as 3% this year, immigration. So it won't be easy to see a headline recession in Australia, but quite possibly per capita.
All right, we've got a couple of questions and then maybe the viewer question of the week.
We do. So a question from Marcelo for Dave, asking if India can be the major buyer of iron ore going forward.
No. It's got heaps of its own. In fact, it's got surplus iron ore. It's got piles of it sitting around. It could export a lot more than it does. And B, I just don't think India will be centralised and how can I put this, cogent enough in government organisation to ever generate enough investment. It's too decentralised and diversified to be another China. The one where India is likely to buy more is coking coal and thermal coal over time. So if you're looking for the India story, it's going to be more energy, I think, than iron ore.
Okay, fantastic. And we've got a quick one from Jude. So they're asking, what are your thoughts on fertility rates and peak population occurring sooner rather than later?
In any particular country, or
let's go to Australia.
With Australia,
I think we might let's pick on the three. The global one, your China and Australia. I think they're probably the three I'd pull out. So for Australia, it's not as much of an issue in that we are running very high rates of immigration, and so we've got lots of people coming through. There's an aging population globally, I think, certainly, and very much so in developed countries. So that will be that's going to be a theme, an investment theme that we need to keep track of. Having said that, people are working longer as well, and so it's a little bit swings and roundabouts. But I do think there's I do think there's an element of that's coming sooner than expected, and what that means, as an aggregate level across multiple countries is lower demand for houses, lower demand for the types of goods that would go into younger people's lifestyles, and more demand for the things that people do once they retire, whether it's travel and things like that. And so as you're looking at goods, I think that's one part.
Blue rinse dye.
Sorry, what's that?
Go long, blue rinse dye.
Blue rinse dye, that's right. Yeah. Well, and there's always the
prune juice.
The one where I can't remember when it was, but it was there was the famous one where the sales of adult diapers in Japan exceeded the sales of child diapers.
Really?
So, yes, there's there's an offset there.
Oh, that's unsettling.
Yes. That was a long time ago. That was sort of 15. I feel like that was 15, 20 years ago. Yeah.
Wow.
So there's that, and the bigger one though is the question on China, and so they're facing some pretty sharp demographic issues, some very sharp demographic issues, and potentially they've been overstating their demographics, as I've sort of mentioned here before, and if they've been overstating it anywhere near as much as what it seems like they have, then it turns like a dire demographic outlook into a catastrophic demographic outlook. So we never know, and we won't know for years. But I'd say if you're worried about demographics, it's the demographics of China you should be most worried about. That they're going to look very much like Japan a lot sooner than and it's going to take them a lot less time than what it took Japan to get there.
Excellent. So now we have the question of the week. So this is for viewers to have some discussion in the comment section over the coming days. So the question for this week is, what is the major investment theme for 2023? So feel free to post your thoughts and engage with us and some of the viewers over the coming days. So that pretty much wraps us up. So Dave, thanks again for putting on the show. It's really informative, and I hope the guests got lots of nuggets out of that one.
Thanks, Sam.
Thank you, Sam.
Excellent. So we do welcome your feedback on the show, especially in regards to suggestions for future topics. If you do have any ideas, please drop it in the comments section below or send us an email at contact@nucleuswealth.com. Just a reminder, this is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to our website at nucleuswealth.com/contact and book a call with myself. Don't forget to like the video now, and if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you can please share it with them. Also, if you'd like to see more of our previous episodes and content, head over to nucleuswealth.com/content or subscribe on our homepage for our weekly Nucleus news and investment insights. And of course, you can follow us on all major social media. Hey guys, I've just realized there was one other slide. There's investment implications. So let's do that one before we quickly wrap up.
Yeah, sure. Dave, I'll let you can take it this one. Take the first one for the year.
Well, these are the conclusions we're drawing out of that presentation. And so we're long bond portfolio, relatively long duration, looking for peak inflation and falling yields, expecting a stock correction. So within that, we're underweight stocks and long defensive, short cyclical. As discussed, think the Australian dollar bottom is in, but some further weakness is likely as we chew through those first two asset stories. And finally, the Aussie property bust is one for the history books. We think it's got, good further downside and will force the RBA's hand sometime later in 2023.
Okay, fantastic. So that finally does wrap us up now. So thanks for that, guys. And from myself, Damien, Dave, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.